the most important gold merger and acquisition chart in the world. If you own any gold, silver, or mining stocks, this is a must watch. Today, I'm going to get you up to speed on the overlooked risks to some of your biggest gold holdings. I'm not making any friends with this theory, but I have to prepare my portfolio for the risks. Before I get into this, you have to know what a US dollar swap line is. So let's review. A swap line provides temporary US dollar relief to central banks of certain nations, those that are pre-approved by the US Fed. Right now, as of this recording, there are 50 nations that have been pre-approved and using US dollar swap lines. These nations need these financial lifelines to ease the stress caused by a lack of US dollars in their own nation. Make no mistake, and don't listen to the dollar demise crowd. The world still needs more US dollars right now. Because of this, we'll see countries declare bankruptcies and we'll see nationalization of certain assets. Let me explain why this is so important. The US government will only give swap lines to countries that are allies. That's countries the US government trusts and works closely with. Countries either have a swap line, meaning their existing US swap lines that I call positive swaps, or do not have a swap line. No US swap lines that I call negative swap line nations. Countries with swap lines accept and obey the terms and conditions set by the United States government. When Russia and China get US swap lines, then I'll change my theory. I do not see that happening anytime soon. Let me give you a real world gold producer example. I've shared this with some of the bigger fund managers in the business, and they had no idea what was happening. In fact, I spoke to some of the largest gold producing CEOs and chairmen, and they had no idea what a swap line was. Not a single executive of a gold mining company knew what a swap line was until I walked them through it. It doesn't matter whether we use places like Argentina or Turkey as our example. This will become the norm over the next few years in all negative swap line nations. A negative swap country like Turkey doesn't allow you as the gold company to sell the gold you've produced easily into the international markets at the international going spot rate, for example, a foreign-owned smelter. This would allow the US dollars to go home to their owners without any meddling of the Turkish government. Here's what actually happens. The company sells their gold to the government in the local currency. In this example, it's the Turkish lira. Here's what I see happening in the near future in places like Argentina and Turkey. The gold producing company sells the gold that they have produced in that country to the government in the local currency. Let's use the hypothetical example of Turkey. That means the Turkish lira in this case. At the government's exchange rate, not the real world exchange rate of the US dollar to the lira, but the Turkey government fixed rate. This means the foreign company will get screwed on the exchange rate. The government takes the gold, which is valued in US dollars globally. Then the company converts the Turkish lira into US dollars through the government at the government's conversion rate. Again, you know that the company is going to get screwed financially by the government by not getting the actual real world exchange rate, but the government fixed exchange rate. It's very difficult for the company to take those US dollars out of the country, and they'll most likely have to pay a higher tax to do so. It also takes time to move the money out of the country. You can't just move the gold doré bars out of the country easily. The negative swap line nations, like the governments of Turkey or Argentina in this example, will clip both sides of that sale, meaning steps 1 to 3. You can see it's not a good deal for the foreign producer, but what else can they do? Turkey is a pro-mining nation, but that doesn't mean that they will not increase taxes, royalties, etc. on the foreign-owned mining assets and energy assets within their country. Now, I'm picking on Turkey only because it is situated very strategically between China and Russia and the interests of Europe and America. Now, I expect Turkey to do so until the point they are forced to choose between accepting the US terms and conditions to be a positive swap line nation, or if they refuse and go with the EMSP, the emerging market superpowers led by China and Russia. Hence, they decide to become a negative swap line nation. In places like Argentina, the company has strict foreign controls on the currency. It's very difficult to move those US dollars outside of Argentina without getting clipped by the unreasonable government exchange rates and taxes. And there are a lot of exploration companies looking to make money in countries in negative swap line nations. Shockingly, I have spoken to many CEOs of producing gold companies, and not one knew what a swap line was. When I walked them through my framework, each were shocked and had a new perspective on mergers and acquisitions over the next 12 months. Now, this next chart I'm going to show you is a first of its kind ever produced. This chart shows that the top 10 gold producers in the world and what percent of each producer's gold is produced in positive swap line nations, which is in green, and negative swap line nations, which is red. So simply think green is good, red is bad because it implies higher risk. The black box is the percent of the company's gold production in positive swap line nations. The higher the percentage of the exposure of their gold production to positive swap line nations, the better, because it means a lower risk exposure. This chart will eventually be the driving force of the coming M&A, the mergers and acquisition rush I see happening in the gold sector. Right now, many analysts across the board in almost every research outfit give the same financial discount to gold producers regardless of location. So when these analysts create these NPV5s, which is a net present value at a 5% discount, which is the global rate for gold mines, these analysts value the discount rate the same whether it's a positive swap line nation or a negative swap line nation. It's as if the risk is irrelevant to these analysts. That is just wrong. Not all jurisdictions are the same, nor should the discount rates that are applied to these mines in these different jurisdictions be the same. I think we're going to see a major change much faster than anyone expects with regards to gold majors building assets in negative swap line nations. And if you own gold stocks in negative swap line nations, make sure you understand the risks properly.